In the last 24 hours, three things have lined up again in the silver market. And when you connect them, the picture gets a lot harder to ignore. COMEX still shows huge paper volume changing hands every day. Industrial silver demand is still being pushed by sectors like solar and electronics. And China, the biggest manufacturing machine on the planet, keeps sitting right in the middle of that physical demand story. Most people look at those as separate headlines. They are not separate. They are pieces of the same puzzle. And by the end of this video, you'll understand why the real story in silver may not be the headline price at all, but the growing disconnect between where silver is traded on paper and where silver is actually needed in the real economy. Because that is the heart of the issue here. When most people hear that silver is trading on COMEX, they imagine a simple market where buyers and sellers meet, price gets discovered, and that price reflects supply and demand. Clean, efficient, honest. But silver is not just another commodity. Silver sits in two worlds at the same time. It is a monetary metal and an industrial metal. It trades like a financial asset, but it gets consumed like a strategic material. And those two identities do not always move together. In fact, sometimes they collide. That is when things get interesting. If you are new to this space, let me translate the core tension in plain language. COMEX is a futures market. That means most silver trading there is not people taking delivery of bars and loading trucks. It is contracts, it is positioning, it is hedging, it is speculation, it is leverage. The paper market can create enormous volume compared with the amount of physical metal that actually moves. That does not automatically mean fraud. It does not automatically mean a default is around the corner. But it does mean one important thing. Price can be dominated for long stretches by financial flows rather than immediate physical scarcity. And that matters because physical demand does not care about trader narratives. A solar manufacturer in China does not care what a macro strategist in New York thinks about the Fed dot plot. An electronics producer does not care that a hedge fund is unwinding a precious metals basket trade. If they need silver, they need silver. If they can get it cheaper in one market than another, they will arbitrage that. If they see a premium in the domestic market, metal starts moving. Quietly. Logistically. Physically. That is where the silver story becomes much bigger than a chart on a screen. Now step back and look at the bigger demand picture. The Silver Institute said global silver demand was expected to remain around 1.20 billion ounces in 2025, with industrial fabrication forecast to rise to more than 700 million ounces for the first time. That is not some fringe blog claim, that is mainstream industry research. Read that again. Industrial demand alone crossing 700 million ounces. In a market where total supply is not exploding higher. In a market where the industry also projected another sizable deficit, the fifth year in a row. Even though that deficit was expected to narrow from the prior year, it was still described as historically large. That is not the language of a loose market. And here is where mainstream coverage often misses the point. When people hear deficit, they imagine empty vaults tomorrow morning. That is not how commodity markets work. A structural deficit does not mean the market stops functioning overnight. It means the system has to pull metal from somewhere else. Above-ground stocks, scrap, inventory transfers, price-sensitive holders, ETF outflows, cross-border arbitrage. In other words, the market can keep going for a long time while quietly becoming tighter underneath the surface. That is exactly the kind of setup that creates a paper versus physical disconnect. Because on paper, a market can look comfortable. Contracts are trading, spreads are functioning. Screen price looks calm enough. But underneath, the burden of balancing the system gets heavier. The real question becomes this. How long can a financial market price silver as though it is abundant if the physical market keeps treating silver as strategic? That is where China enters the story. China is not just another consumer in silver. China is central to the industrial demand narrative because it dominates large parts of global manufacturing, especially in solar. Silver is a critical input in photovoltaic applications, and even though manufacturers keep trying to reduce silver loading per cell, total solar deployment has been so large that overall silver demand from the sector remains a major force. The Silver Institute explicitly said global photovoltaic installations were expected to hit another all-time high in 2025, supporting silver demand again. And separate industry research noted that over the last decade, global installed solar capacity rose more than tenfold, led primarily by China, while silver demand from photovoltaics tripled over that period, even with thrifting improvements. That matters because it changes the story from silver as optional inflation hedge to silver as non-negotiable industrial input. You can print dollars. You can create bank reserves. You can roll futures contracts. You cannot print silver. And once you understand that, the COMEX question changes. The question is no longer simply, what is silver trading at today? The real question becomes, is the futures market accurately reflecting the growing competition for physical metal between investors, industry, and international buyers? Now let's tighten the lens further. In 2024, reports tied to Bloomberg coverage noted that Chinese silver imports could jump as domestic demand, and local pricing created an arbitrage incentive. In plain language, silver in China was trading rich enough relative to the international market that traders had a reason to move metal into China. Why? Because demand there was strong enough to widen the spread. That is not just a cute data point. That is the market telling you that physical silver was more valuable in one real-world destination than the headline global price might suggest. Let me translate that. If China is willing to pay up, metal moves. If metal moves, available supply elsewhere can tighten. If available supply tightens, while paper market activity remains enormous, the disconnect grows. And once the disconnect grows enough, people start asking harder questions about price discovery. This is why the silver story keeps coming back to logistics, not slogans, logistics, warehouses, deliveries, imports, premiums, inventory categories, because that is where the fantasy gets checked against reality, and that brings us directly to COMEX inventory. One of the most misunderstood parts of this market is the difference between total silver in COMEX warehouses and silver that is actually registered for delivery. People hear a big inventory number and assume all of it is equally available. It is not. COMEX separates stocks into categories. Eligible metal meets exchange specifications and sits in approved warehouses, but it is not automatically committed to delivery. Registered metal is the portion that is available against futures delivery. That distinction matters because when open interest is large but registered stocks are much smaller, the market is relying on most contracts not standing for delivery. Again, that is not a conspiracy theory. That is how futures markets function. But it does reveal something important. The paper market can be many multiples larger than the immediately deliverable metal pool. That is why silver investors watch registered stocks so closely. Not because every contract will demand bars tomorrow, but because inventory composition tells you how much buffer exists if more participants decide they want metal instead of rollover. And here is the subtle shift many people miss. Over the last couple of years, warehouse inventories have not just reflected ordinary commercial hedging, they have also reflected strategic positioning, concerns over tariffs, changes in arbitrage incentives, and the movement of bullion between London, New York, and Asia. The Silver Institute noted that anticipated tariff policies helped fuel deliveries of silver into CME warehouses starting in late 2024. That means at least part of the inventory story was not simply, look how much silver there is. It was also, look how urgently market participants felt the need to reposition silver into exchange-approved locations. Those are not the same thing. Read that again. If silver is rushing into the right warehouse at the right time, that can be a sign of preparation, not comfort. And this is where mainstream financial media often stops too early. They'll say, well, COMEX inventories are up, so there is no shortage. But that is shallow analysis. Inventory arriving at exchange warehouses can mean many things. It can mean supply is ample. It can also mean market participants want metal closer to where futures delivery risk is concentrated. It can mean tariff uncertainty is changing location preferences. It can mean arbitrage flows are active. It can mean the system is adapting to stress rather than floating above it. Those are very different interpretations. Now let's widen the supply side, because demand stories only matter if supply cannot instantly respond. The US Geological Survey estimated world silver mine production at roughly 25,000 metric tons in 2024, down from about 25,500 metric tons in 2023. China remained a major producer at around 3,300 metric tons, but the global leader was still Mexico, and the broader point is the key one. Silver mine supply is not a tap that turns on because price blinks higher for a quarter. Silver is heavily produced as a byproduct of lead, zinc, copper, and gold mining. USGS explicitly notes that silver is primarily obtained as a byproduct. That means the silver market does not fully control its own destiny on the supply side. If copper, zinc, or gold economics drive mine planning, silver supply can lag even when silver-specific demand rises. That is huge, because it means a rising industrial need for silver does not automatically bring a proportional rise in primary silver output. There is inertia in the system. There are permitting delays, there are capital constraints, there are geopolitical risks, there are grade issues, there are cost pressures. And because so much silver comes as a byproduct, the market can stay tighter for longer than a casual observer expects. This is one reason silver keeps behaving differently from how textbook models would predict. The paper market sees liquidity. The physical market sees bottlenecks, the futures chart sees positioning, the industrial buyer sees lead times and procurement risk. Two different realities, same metal. Now here is the midpoint twist that should make you stop and think. Even with all of this industrial demand strength, silver has often looked relatively cheap compared with gold. The gold-silver ratio has stayed elevated for long stretches, and the Silver Institute itself noted that concerns about China's broader economy helped weigh on silver, helping explain that elevated ratio. So on one hand you have repeated talk of deficits, record industrial fabrication, solar demand, and tight physical signals in certain channels. On the other hand, silver can still trade like the market is unconvinced. That contradiction is the entire story. If silver were only an industrial metal, maybe the price would be higher already. If silver were only a monetary metal, maybe physical offtake would matter less. But silver is both. And that means it gets pulled in opposite directions. Macro fear, recession concerns, dollar strength, rate expectations, China slowdown worries, all of those can suppress enthusiasm in the paper market even while physical usage remains stubbornly strong. That is why silver can look sleepy right before it stops looking sleepy. And that brings us to the part that the media really does not like to emphasize. Price discovery in silver is not happening in one clean place. The London OTC market matters, COMEX matters, Shanghai matters, industrial contracts matter, ETF flows matter, refiner activity matters, dealer premiums matter, import data matters, delivery notices matter. You have to watch the whole map, not just one quote on a screen. If you only watch COMEX front-month price, you are seeing one layer of the story, not the story itself. This is especially true when China is involved, because China can affect silver in multiple ways at once. It can influence fabrication demand through solar and electronics. It can influence investor behavior through precious metals substitution when gold gets expensive. It can influence trade flows through arbitrage, and it can influence sentiment because traders around the world are constantly trying to guess whether China's growth weakness or manufacturing strength will dominate the silver narrative next. So when someone says, silver isn't doing much, therefore there's no real stress, ask yourself a better question. Stress where? Stress on a chart, or stress in the physical procurement chain? Let's go one layer deeper into COMEX mechanics, because this is where a lot of viewers already know the headlines, but not the structure. Futures exchanges work because most participants do not take delivery. They offset, roll, hedge, or cash settle economically, even if the contract is physically deliverable in theory. That allows the exchange to support far more notional trading than the amount of registered metal sitting there. Again, that is normal, but normal does not mean irrelevant. What matters is what happens when more people than usual decide they do care about physical. Then inventory categories, delivery notices and spreads suddenly matter a lot more. And that is why every period of heightened attention in silver seems to produce the same debate. Is the paper market suppressing a real physical signal? Or is the physical market just not tight enough yet to force the paper market to reprice? That is the debate, not some cartoon version. That is the serious version of the debate. My view is that the answer is often neither extreme. The paper market is not omnipotent forever, and the physical market does not always win immediately. What happens instead is a lag. The physical market tightens, logistics adapt, inventories shift, metal gets pulled from one region to another, premiums change. Analysts argue the price looks oddly contained, then suddenly, sometimes violently, the market reprices. Not because the story changed overnight, because the market finally admitted what had already been building underneath. That is why the repeated deficit language matters so much. The Silver Institute's 2025 outlook did not describe a one-off anomaly. It described a fifth consecutive annual deficit, driven again by industrial demand. Think about what that means psychologically. We are not talking about a single bad harvest or a temporary shipping issue. We are talking about a multi-year backdrop where the physical market has needed ongoing adjustment mechanisms just to stay balanced. That is not how permanently abundant markets usually look. And yes, recycling helps. The Institute projected recycling above 200 million ounces in 2025, the highest since 2012. But recycling is a response, not a miracle. It can ease pressure. It does not erase structural demand growth from sectors that increasingly treat silver as essential. That brings us back to China and the bigger geopolitical frame. When the world's largest manufacturing center is hoovering up strategic inputs for energy transition, electronics, and industrial output, that is not just a commodity story. That is a geopolitical finance story. Because then, silver is no longer merely a precious metal sitting next to gold in a portfolio discussion. It becomes part of the infrastructure race, part of the electrification race, part of the supply chain security conversation. And here is a clue that this shift is becoming more official. In late 2025, the US government added silver to its final 2025 list of critical minerals through the USGS process, explicitly recognizing silver's importance to economic and national security supply chains. That does not instantly change the price tomorrow morning, but it does tell you something about how policymakers are increasingly forced to look at silver, not just as jewelry or bullion, but as a strategic material. That is a huge framing shift. Let me translate that too. The more silver is viewed as strategic, the less sensible it becomes to value it only through a paper trading lens. because strategic materials do not stay casually mispriced forever if real-world demand keeps expanding. Now, does that mean silver must explode next week? No. And this is where we stay disciplined. The silver market is famous for frustrating both bulls and bears. It can remain range-bound longer than almost anyone expects. It can get hit by risk-off liquidation even when the physical thesis is intact. It can underperform gold during certain macro windows. It can get pulled around by dollar strength, rate expectations, or fund positioning. That is all true. But none of that cancels the underlying signal stack. Signal 1. Global silver demand remains high, with industrial demand pushing toward record territory. Signal 2. The market has been running recurring deficits, meaning supply has not cleanly outpaced demand. Signal 3. China remains central to the physical story through manufacturing and solar demand. And periods of premium-driven import pull show that physical silver can become more valuable in China than in the headline international market. Signal 4. COMEX is a massive paper market where inventory categories and deliverability matter because price can be influenced by financial flows long before physical tightness is fully acknowledged. Signal 5. Mine supply is constrained by the fact that silver is often a byproduct, which limits how quickly the market can respond. Individually, you can argue with any one of those. Together, they point in the same direction. That direction is not necessarily immediate shortage panic. The direction is persistent market tension beneath a paper price. And if you are paying attention, that is the real opportunity, not to scream about apocalypse, not to invent fake data, but to recognize that silver may be one of those markets where the official price can look far more relaxed than the underlying system really is. This is also why the silver story attracts such a specific kind of investor, because it is one of the clearest examples of how modern markets can appear orderly on the surface while carrying real structural strain underneath. The average viewer sees a commodity quote. The attentive viewer sees a global balancing act involving futures leverage, industrial demand, geopolitical trade flows, and strategic resource competition. That is the difference, and it is why people who follow silver closely often feel like they are watching two movies at once. In one movie, silver is just another ticker, bouncing around with macro sentiment. In the other movie, silver is being pulled into solar expansion, electrification, electronics, and national supply chain concerns, while exchange inventories and cross-border flows quietly absorb the pressure. Eventually, those two movies have to meet. That does not mean the convergence date is easy to call. It means the convergence logic is getting harder to dismiss. So when somebody says, if physical demand is so strong, why hasn't silver completely broken out and stayed there? The answer may be simpler than they want, because financial markets are forward-looking, but they are also noisy, because futures markets can absorb a lot of tension before they snap to a new level, because macro fear can temporarily overpower industrial strength, because investors get distracted, because headlines chase the Fed, not warehouse dynamics, because the media would rather cover a clean story than a complicated one. But complicated stories are where the money is usually made. And silver is a complicated story. It is a commodity. It is a monetary metal. It is a strategic industrial input. It is a physical market traded through enormous paper turnover. It is a byproduct metal trying to satisfy primary demand growth. It is a market where China can matter through demand, even when Western commentary is focused somewhere else. That is why this matters for investors. If the disconnect between COMEX pricing and physical demand is real, then silver is not just volatile, it is potentially misread. And a misread market can stay misread longer than people expect. But once the narrative flips, it tends to flip fast. That is the asymmetric part of the setup. Maybe the trigger is another wave of industrial demand surprises. Maybe it is a tighter arbitrage window with China. Maybe it is another inventory relocation event. Maybe it is a broader precious metals move led by gold. Maybe it is policy. Maybe it is tariffs. Maybe it is just the slow realization that repeated deficits are not supposed to be ignored forever. Whatever the trigger is, the groundwork matters more than the trigger. And the groundwork right now is not screaming abundance. It is whispering tension. That is why the smartest way to watch silver is not to obsess over one day's candle. Watch the convergence. Watch the warehouse story. Watch registered versus eligible. Watch delivery patterns. Watch solar demand. Watch import flows. Watch how China prices silver relative to the international market. Watch whether industrial strength keeps outlasting macro pessimism. Watch whether the market keeps needing new balancing mechanisms to avoid a more obvious repricing. Because if it does, then the paper versus physical debate is not some internet slogan, it is the map. And once you see the map, the headlines start looking very different. So here is the big takeaway. COMEX silver may still dominate the visible price. But physical demand, especially when you bring China into the equation, keeps sending signals that the visible price may not be telling the whole story. Not yet. Maybe not fully, but enough to matter, enough to watch. Enough to recognize that silver is not just trading as a metal. It is being fought over as a function of finance, industry, and geopolitics all at once. That is a different market than the mainstream narrative usually describes, and that is exactly why we keep coming back to it. Because the people who get blindsided in markets are usually the ones looking at a single indicator and calling it reality. The people who get ahead of the move are usually the ones willing to connect the signals before the consensus catches up. That is what this silver setup is asking you to do. So now, I want to hear from you. Do you think COMEX is still giving a fair price for silver? Or do you think physical demand, especially from China and industrial buyers, is building pressure that the paper market still is not fully pricing in? Where do you think this goes next? And if you're the kind of investor who wants to track the signals beneath the headlines, subscribe and stay with us, because this is exactly why we cover these macro and metals developments every day here on Safe Haven Metals.